built the wall up around himself, and the other employees felt the same way. They wouldn't even speak to him. You know, it's almost, they'd ride in the elevator in total silence.
Fuld built up a network of over 60 offices around the world, employing more than 28,000 staff. When Lehman Brothers opened a grand new European headquarters at Canary Wharf, the bank had truly arrived.
Let me formally declare this new building open. Thank you very much.
Dick Fuld's unorthodox style of leadership meant he was admired and feared in equal measure.
Dick took the floor like a statesman, and he proceeded to deliver this fearsome attack on short sellers, the people who were depressing Lehman's share price by being short the stock. And he, rather to everyone's surprise and mystification, he said,
if we get this right today, hope it will squeeze some of those shorts. Squeeze them hard. Not that I want to hurt them. Don't get that, please, because that's just not who I am. I am soft, I'm lovable. But what I really want to do is I want to reach in, rip out their heart, and eat it before they die.
Dick Fuld also had an insatiable appetite for profits, with or without fava beans. And he delivered. In 1994, one share cost $4. As the economy boomed, by 2007, that investment was now worth $82, a 20-fold increase. And how had the bank done this? By expanding into lucrative new products as the market became less regulated. Highly complex products, including credit default swaps, a kind of insurance against borrowers defaulting on loans. Risk was the name of the game.
As a trader, you take risk to make profits. The more risk you take, the more money that you're playing with, the more profits you can make. In the case of Lehman Brothers, Dick Fuld essentially said to our head risk taker in commercial mortgage-backed securities, you got to take more risk. Risk, 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 risk. And that risk leads more to the bottom line.
I think Wall Street found, but also a lot of other people believed, that modern finance was a form of alchemy, that it was a way of taking risk and distributing it very widely, so widely that the overall system was de-risked. And this built up a sense of false confidence in the markets.
And for the staff who signed up to Dick Fuld's credo, along with the bottom line came rewards which were life-changing.
In a good year, as I had in 2006, I made more than $30 million. That gave me more than $1 million bonus. And I know traders that made $10 million in a year, in a good year. But those type of traders made north of $100, $150, $200 million for the firm.
In 2004, Lehman's turnover was $11.5 billion. It rewarded its staff over $5 billion in pay and bonuses. By 2007, turnover had almost doubled, with staff collecting more than $9 billion in pay and bonuses. And top of the pile was Dick Fuld. From the year 2000 to 2008, he took home between $310 and $500 million. The precise figure is disputed. Now, at the Fed on that Friday night last September, the rivals Dick Fuld had boasted of crushing were sitting in judgment over him. He had not been invited to the crisis meeting of chief executives. Even some on his own side felt his combative nature would be an unhelpful distraction. After the bank chiefs had left the building, their accountants and lawyers carried on working through the night.
The smell of stale pizza and unwashed bodies is not all that appealing, but you learn to live with it as part of the business. But the intensity was at a much higher pitch than is normally the case, because the stakes were just so high.
They were carrying out due diligence, going through accounts to piece together an accurate picture of the bank's finances.
To be frank, we had trouble getting traction. And it was clear to us that the management of Lehman Brothers was spending an awful lot of time with at least one other firm going through due diligence. And so we got off to a slow start.
That was because Lehman's was giving its attention to that other suitor. Bank of America was the favorite to buy the ailing investment house. There were highly profitable parts of Lehman Brothers, like the investment division, which they wanted to salvage. But when its advisors started going through Lehman's accounts, what they found appalled them.
I have to say that although we were expecting not to be very happy with what we saw, it was worse than what we'd expected.
They calculated the property crash had left a massive hole in Lehman's balance sheet. Just a month before, the bank had said its portfolio was worth $40 billion. Now it had fallen to around $25 billion.
They might have paid $100 million for a property, and on their balance sheet it says it's worth $100 million, but the reality was it was worth $50 million or $25 million. And when you start adding all those losses up from this property and that property and so on, it ended up adding up to a very big number. A number that was so large, the losses were so large, that it really meant the company was bankrupt unless it got support from the U.S. government.
But the man in charge of the U.S. Treasury, Hank Paulson, had already made clear that was not an option. What happened next took everyone by surprise. The following morning, most New Yorkers were oblivious to the drama playing out down in Lower Manhattan. And as the morning went on, the stakes got higher. Dick Fuld was still counting on Bank of America making him a proposal, but was about to learn that his suitor had a roving eye. John Thain, the chief executive of Merrill Lynch, was the new kid on the block, but he had his own problems. Merrill Lynch's share price was going down because investors were selling, fearful of how exposed this bank also was to the property slump. So when he returned to the Fed on Saturday morning, he took a particularly close interest in the predicament facing his rival. Watching Lehman's representative wilt under the pressure, he began to fear attention might next switch to his own troubled bank.
Seeing him and understanding the emotional drain of what was happening to him, and then knowing that on Saturday that it was likely they were going to go bankrupt, so all of their efforts were going to fail, in some ways reinforced with me, I didn't want to be that person a week later.
So he grabbed the chance to save his own bank.
And so from my perspective, the problem no longer became how to save Lehman, because I assumed Lehman was going to go bankrupt. It became, what does that mean for the financial markets, and what does that mean for Merrill Lynch, and how do I make sure that I protect Merrill Lynch's shareholders and Merrill Lynch's employees and Merrill Lynch's clients so that, Merrill Lynch isn't in a similar position a week later.
He decided to contact Bank of America's chief executive, Ken Lewis, at home in North Carolina, and made him an audacious offer.
I stepped out of the building and actually stood on the sidewalk on the street and called Ken from my cell phone. The conversation was relatively short, and I said to him that I thought it made sense for us to explore some strategic options. He said, great, I can be in New York in a couple of hours.
All bets were now off. It was everyone for themselves. As Bank of America's boss was flying north on his secret date, Dick Fuld had no idea he'd been dumped. Excluded from the Fed, he had spent the morning holed up in Lehman's Midtown HQ.
Dick would occasionally ask, have you heard anything back from Bank of America, because we still found it difficult to believe they had disappeared. And the answer, of course, was always no.
Just a few blocks away, John Thain began to hammer out a deal with Bank of America's chief at a discreet hideaway by Central